Good morning, everyone.
Good morning.
Please,
Good morning, sir.
I hope we are all doing well.
By God's grace.
Right. All right. So we are back to class. Another session of our semester courses where we need to do a course named as Advanced Financial Reporting. Um, this time, we want to change the narrative. So, what is at stake of us? We have realized that advanced accounting book one that you people went for it from the center, it is something we need to improve upon. So, though we have given you the manual, but we also want to meet you halfway for you to understand certain things in accounting. So, what do we intend to do? Yesterday evening, I shared, there is an Google link going up and down for we advanced financial reporting students to go and access the document to see the uh, the content of that document and to know the things that go into it. In that Google Drive, you have access to video links, you have access to questions, you have access to all the what it takes you to pass this course. Students have been complaining that advanced accounting is difficult and that they are not able to pass. So this time, uh, the chief the chief sat down and realized that she needs to improve upon certain things to help students also pass. So this time, we have brought to you something that we think that it is going to assist you to pass. So you shouldn't be that I don't know and that I didn't get access to the document and that because coordinators have been given a Google Drive and I even have placed it on our pages that we should access the document and have access to the new outline I am showing on your screen now. So what does it take? What it means is that the book you went for it at the center can be a hard copy of as a reference material, but all the documents you'll be sharing on the Google Drive is what you should sit down to be reading. And if you go there, it is very simple. The things are there. They're very, very simple. Theory, they are just there for you to be reading, for you to understand the content of the course. And I believe that by the time we are done with this course, everyone will appreciate that indeed they understand the issues that were explained to them. So, what is my name? My name is Emmanuel Samoa. I'm from the Department of Accounting, University of Cape Coast, School of Business. That is where I find myself, together with my other colleague who is teaching both Botek, Sokode, and Keita. He is also is called Foster Segbe. He is also is teaching other group, and I'm also teaching STU, WA, Enchi, and Fiasaman, then Bombe students. And I'm hoping very well that by the time we end with this, together with my colleague who is teaching the other three centers, Botek, Sokode, and Keita, we'll all be at the same level to explain the issues so that we will appreciate. Other colleagues also are at the various centers teaching the same course this morning so that we all be at the same level. So that is my information to everyone, for everyone to know that this time we are going to use the document I have uploaded. And this document will help each and everyone to use. So maybe someone will ask, but say, please, where is the link? Because the link is on the page if maybe you have not gotten it yet, or if you are still So if you have still not gotten the link, then as soon as possible, I'll share it on the chat box for us to, in the chat box where you can also have access to it. You want everyone should be able to access the document and then appreciate the things in a document. Everything over there is self-explanatory. But since you are in class, I'll try my possible best to explain the issues to you for you to understand. So when you go into the document, you see something like this. You see something like this. So when you click on the link, you see something like this. We have the course outline, the one I have shown with you, and the unit 1 materials. They are all there to assist you. And they are just very, very simple. They are all reading, of which you'll be able to understand the issues. That is what we have to do. So note that the link has been placed there. Find time, access it at any time, because at any point in time, we are going to update the link, and then you have access to all the questions, all the documents. So we don't have an excuse that this course is difficult, because we are going to make it simple for you. We are going to make it simple for you. So back to the outline. I know I can see Ajua here, I can see Albert, I can see Pedro, I can see Benedicta, I can see Bernard, I can see Emilia, Eric, Ernest, Hannah, Isaac, Jennifer, Kwejo, Asamoah, Menuata, Mavis, Patrick, and then that of so Patrick, and that'll be all. Right. I'm hoping that by the time we are about finishing, I'll get to know other people who are also online. So what are we doing this morning? We want to understand really about this semester. The issues are few, but they are a little bit many. But what happened is that when you have businesses, those businesses in Ghana here, if you're a company in Ghana here, you are expected to prepare an account. And the companies at 992 2019 governs, or is the regulations or the act that requires you to prepare an account. And if you are preparing an account, we expect that as a company in Ghana here, you are expected to publish your statement of financial position, of which some of you call it balance sheet. You are expected to prepare comprehensive income, or some people will start statement of profit or loss and other comprehensive income. You are expected to prepare statements of changes in equity. You are expected to prepare statements of cash flows, and as well you are expected to prepare the notes to the account. So these 5 main financial statements, you are required as a business to prepare it. So even if you are the sole owner of a company, this is not a sole proprietor, because in company law we said that one person can also form a company. But when a person form a company, at least you should have what? 2 directors and a company secretary who happens to become a lawyer or a solicitor. So that is what is requiring us to have as what? A company. So even if you are a one-man company, or you have a group of company, for example, despite, for example, multimedia group of company, for example, NG group of company, even if you have several other companies below you, you expected to follow what? The companies at 992 2019 to prepare your account. That is it. But hold on, with these companies following the company's account, there are other entities who have acquired other businesses. So they have gone to purchase other businesses, of which those businesses has become their subsidiary. So when you were in level 300 second semester, doing corporate financial reporting at unit 6, corporate financial reporting at unit 6, you were introduced to an issues called consolidation of financial statement. You were introduced to that. So when you were introduced to it, they told you that when you get to level 400, they will throw more light on it. So this is the time that we want to appreciate that there are some businesses that one or the other, we have the owners who are, we have owners who may also have acquired other businesses so that they can have control over them. So if a business have control over another business, you will say that that business the person has control over, that business is the business subsidiary. So please, 1 minute. Okay, so when you are having those businesses there, they are saying that those businesses you are having in your subsidiary because you have control over them. So anytime you have control over another business, that business is your subsidiary. That business is your subsidiary. So you may have like company A, and that company has acquired company B. And because company A has control over company B, we will say company B is the subsidiary. Now, if you are able to establish that you have control over that particular business, you have control over that particular business, then you will say the company B is your subsidiary. Subsidiary. That business is your subsidiary. Please, 1 minute. Okay, so what happened is that if you are able to say that the person you have control over that particular business, I said that business become your subsidiary. But then if you do an investment with another business, so company A now goes to company C, and that company C, he has what gone there, the person is the person is just an investment of which he has between 20 to 50 percentage of holdings. 20 to 50 percentage of holdings in company C. So if you have 20 to 50 percentage in company C, we will say that that company C is company A's associate. Note that. Companies A's associate. Note that. So if A has between 20 to 50% in company C, we will say the company C is associate because company A has what we call significant influence. Significant influence. So anytime a business has a significant influence in another business, that business it has significant influence is called an associate. Is called an associate. Now, if A also says that I am going to I'm going to have an investment in D. I'm going to have an investment in D. So if he's going to have an investment in D, and he's going to have between 1 to 19% of holdings, 1 to 19% of holdings, what happens is that that company is what? It's just a simple investment. So if you go to a company and you have company A has between 1 to 19% of holdings, that business become a simple investment. But when A together with Z decide to form a business, Y, when A together with Z comes together, bring their resources together and decide to form a business, when they all bring their resources together and they decide to form a business, we will say that that business they are formed is a joint venture. Note that that business they are formed is joint venture. So when A and B come, this is not a partnership. This time they have agreed that the two of them will bring their resources together and then they will form a business based on a particular agreement. Please, this one is not a partnership, but they are pulling their resources together to form a different business. So A is a different business, Z also is a different business. They're not individuals, they are different businesses. So they decide that we are coming together to form a new business. That business they are forming, we will call it a joint venture. Then again, A also met maybe Q. A met Q, and they said that, okay, I have a particular resources. Yes, Mahmoud.
Yes, sir.
Yes, sir.
Please, I try to follow the Google Drive with what you are doing, but it's like on the Google Drive.
No. The Google Drive is where you can access material, please. Where you
Yes,
can
please.
access the material. Yes.
Yes, please. I'm coming. But on the Google Drive, we have advanced accounting one, not financial reporting. I don't know whether it's a mistake or it's at my case.
Please, I told you that we should check our chart right away here. This chart, the chart you have over here. When you click on that Google Drive, you are going to see the document you are using for the class, and at the same time, that Google Drive has been shared on in the online page for you. So you should be able to access this. So all of you should click on this link. It will give you, or you should copy this link down. It will give you all the material you need for advanced financial report. This is what you registered for. So this is what we are giving to you. Are you satisfied? Okay. So when A and B comes together and they said that, okay, they are not, A said, I have something. You too, you have something. Let's go and do an operation. Oh, you bring your resources. Let me bring my resources. Let us go and do an operation. Oh, that operation now becomes
Sir, please, you are muted.
Yes, please. I'm sorry about that. So let's continue. So when A and Q comes together to bring their resources together, this time they are not forming a new company. They are not forming a new company, but they want to undertake an operation O. So it's like the police and then the military people, other security forces coming together to go and undertake an operation. So the operations may be there's an election. So military will bring his resources, police will bring their resources. They want to undertake the operation. Everyone is entitled to his resources. Police will not go to military and say, give me your cars. No. The military also will not go to the police and say, give me your cars. No. We are all bringing our resources to undertake an operation. When they come together and they are going to undertake that operation, we call that operation joint operation. So when two businesses come together and they say they want to undertake an operation, and that operation, we finalize it and say that, okay, these two operations, this operation we are going to take, there is going to be, you bring your resource, I'll bring my resource. When they come together to undertake that operation, it is called a joint venture. So in Ghana, here we all know that Ghana and Nigeria, at some point in time, there is a gas pipeline. So let's say, for instance, the gas pipeline is owned by Ghana and the gas is owned by Nigeria. So Ghana and Nigeria government will sit down and say that, okay, let's undertake an operation where I have the gas pipeline. You two, you have what? The gas. So why don't we come together and then supply the gas to some particular people so that they pay for it? So in that instance, when there's a problem with a gas pipeline, what happens is that Ghana will repair it. When there's a problem with a gas issue, Nigeria people will do it. Another simple example are the people who have oil, fuel, and those who have the pump. So the fuel stations, someone will have a fuel station. Another person also will have an oil. And they said, because you have a fuel station and a pump, I want to bring the oil for you to sell on my behalf. So that when you sell, if there's any profit, we share it. So when they undertake that thing, where someone will supply with the petrol tankers, bringing the oil, and then the other person also will take some stuff and they will be at the fuel station to be selling the fuel. They have entered into what we call a joint operation. This is not a partnership. This is different from partnership. So this is different from partnership. This time, you have what? A fuel station. I have what? Fuel. I have petrol tankers. So when there's a problem with the petrol tanker or from my fuel side, I am to handle it. I bear only the liability and I already have right to my only asset. You don't have access to my fuel tanker. You don't have access to my drivers. You don't have access to my fuel at my place. I only bring the fuel to you at your pump site, and I don't control your people who are doing the selling of it. But when they come together, they enter into agreement. That agreement, they call it joint arrangement. Joint arrangement. So when A and Z enter into agreement where they decide that they want to have a joint venture, or A and Q enter into agreement where they decide to have a joint operation, this process, they go through a particular agreement. The agreement is called joint arrangement. Joint arrangement. So this semester, you'll be learning concerning joint arrangement. So I've given you 4 different types of investment. An investment where you have control and the person becomes your subsidiary. An investment where you have significant influence and the person becomes your associate. An investment where you have a simple investment where you have between 1 to 19%. and an investment where it's a joint arrangement, which will give birth to what? A joint venture or a joint operation. So this type of investment is what we are going to learn this semester. So this semester, you'll be looking at these main 4 types of investment, where the investment is a subsidiary, where the investment is an associate, where the investment is a simple investment, where the investment is a joint venture. But this type of investment are governed by certain standards. So when we come to A and B, where there's a subsidiary, we are going to use IFRS 3. So when we have control over B, we are going to use IFRS 3. When you are bringing the results of B to A together and you are going to present it as one, you are going to use IFRS 10. Again, if you have A, if A has acquired B and has control over B, we are going to use a standard called IFRS 3, business combination. When A and B come together and they present their results as one, the standard which is going to help us is IFRS 10. That is what we should know. When A go and acquire C, and C now become an associate, the standard we are going to use is IAS 28. That is investment in associate, of which we'll be talking about them today too as well. Then when A go and acquire D, the standard we use is IFRS 9. This IFRS 9, you did it in level 200 when you are doing financial instruments. So you will not spend much time there. But when A and Z come together to form a joint venture, or A and K come together to form a joint operation, we are going to use a standard called IFRS 11. So what it means is that the standards we are going to use for this course is for these issues will fall around IFRS 3, IFRS 10, IAS 28, IFRS 11. Then later on, we look at issues concerning, if you want to be issues concerning disclosure of entities, interest in other entities, you should. And then please, I will call you. I beg you. Can you mute yourself? I beg you. If you want to look at issue concerning disclosure of interest in other entities, we will look at it. If you want to learn about related party disclosures, we will look at it. If you want to look at other operating segments in organization, how do we present if a business have segments? So you have like an organization where they have divisions, they have segments. For example, if you go to Unilever Ghana, you have the healthcare and or personal care products. You can have food care and can also have health care. So all these products are there with the organization. So they have different segments, different divisions. So how do we do the reporting on these different segments we have? Now, if a business engage itself in a foreign transactions, what are we going to do? How do we account for it? So maybe a company is in Ghana here, he has another business in UK, he has another business in US. What happens is that if you want to do it, what are the standards that will govern us? We will learn this semester. Then, when we look at this unit 1 and unit 2, we will now come to unit 3, where we will start the calculation proper. So unit 3 is where the calculation will start from, where we will now do the A acquiring B, that is having control. This is where we now get to know the computations that are involved. Then that is when you are doing statement of financial position. That is when A has gone to acquire B. And then as well too, when A has acquired C, when A has acquired C, that's investment in associate, we will learn that one too in unit 4. Then unit 5 and unit 6 is where the presentation things will start from. So I will teach unit 1, Unit 2, Unit 3, Unit 4. Then Unit 5 and Unit 6. I will give you opportunity. I'll not give the topic to you to go and do it. No, I'll give you questions for you to go and solve it. Then come back and come and explain the concept called earning-based method. Add examples to it by solving questions with us. Then dividend-based also, I'll give you questions on it. But when you come to present, what you are going to do is that you are going to solve the question that I gave you as part of the presentation. Asset-based method too, you go and do a PowerPoint on it. But when you come to class, well, after presenting on the topic, you solve the question. And other valuation, you do that. Then another set of group also will deal with the current issues in financial reporting, where there are no calculation. They'll come and do the theory with us. So that one too, I will send a few questions to guide them when they are doing that. So Unit 5 and Unit 6 is where your duty will come. But my duty will be on Unit 1 and Unit 4. So what is happening? This will be our meeting time. So today we will meet. I don't know whether we have education people in class. Do you have education people here as part of the group here? Do you have anyone doing BEd accounting here?
Yes, sir. Yes, sir. We are here.
All right. So BEd accounting people, do you have a class from 11:30 to 12:30? I don't think so.
Sir,
I don't.
please, we will check and get back to you on that.
Right. So check and get back to me, because today at 11:30, Sunday, I'm typing it in the group chat. Sunday, 7 a.m. to 9 a.m. You meet me. Then you meet me at Sunday 7, and then you also meet me at Sunday 11:30 to 12:30 to finish. Then that's to finish. So this is our meeting time on Sundays. Sunday 7 a.m. to 9 a.m. Then from 11:30 to 12:30 p.m. Now, this is for the 3 hours. And then when we get to the calculation side, we will exploit during the week how we can get extra 2 hours. So during the week, we will get so during weekdays, that is when we get to the calculation start, we will pick 2 hours during weekdays to solve the additional questions that we have. Weekdays to solve additional questions. So in all, you will have to spend we have to spend 5 hours with me. So you'll be spending 5 hours with me, where I will do on Sunday 3 hours, and during the week I will do additional 2 hours. So in all, 5 hours. When you spend the 5 hours with me, all the sessions will be recorded. We will share the link with you later on. But kindly note that when you are coming to class, you have to prepare, because the materials will be uploaded for you to prepare, which will guide you in the preparation. So kindly note that this is what I have for you. Now, Ernest, you have raised up your hand. Any question before I start today's class?
Okay, thank you, sir. Sir, please, the model given to us, our unit 1 is on PPE. So that's why I was a little bit confused. Our unit 1 is on PPE.
Okay, thank you. I told you that the school has given you a model, but then we want to align you so that when you are going to take exemptions from ICAG, they can give you exemptions. And ICAG requires us that we have what we call financial reporting 1 and financial reporting 2. The book you are holding is called what? Advanced Accounting. Is it called financial reporting 1? Ernest?
No, please.
Yes, so that is the reason why we have come out with Financial Reporting 1. This book has not been printed. So this book is in soft copy. Now I've shared the link in our chat. I will share the link on our WhatsApp page. All the material, all the questions you need for this course, they are there. So you don't need to worry yourself and complain that the hard copy book is different from the soft copy book. The soft copy book is called Advanced Financial Reporting, but the hard copy book is called Advanced Accounting 1. But the thing in your portal is called what? Advanced Financial Reporting 1. So what does it mean? It means you need to use the Advanced Financial Reporting 1. The book you are having is a reference material. So if you are asking questions under PPE and you don't understand, when we test questions under PPE, you don't understand, that book, you can go for it and use it. So do not discard that book, because that book, if we are doing under consolidation and we want you to understand something concerning PPE, of which you did it in level 200, you did it at first semester, PPE, we want to ask you, go and pick that document and then use it.
No, please.
So Ernest, please, you get what I'm saying?
No, I'm here to do something for you.
Ernest, please, I'm talking to you. Please, I said you understand what I'm saying. I'm saying that the document you are having over there is a reference material. And the one also I'm sharing on a Google Drive on all the pages of which the whole Ghana, everyone is going to use also is for advanced financial reporting. They are all materials you are going to use for this class. So do not disregard any book. I'm being frank over here. Don't put any book aside. You have two reference material. One is on advanced financial reporting 1. One is on advanced accounting. So you are going to use the one you registered for. So what did you register for? You registered for advanced financial reporting 1. That is what you are going to use. So please don't go and stand anywhere and say that we are saying we are not using the hard copy book. The hard copy book, we are going to use it, but it's going to be a reference material. The hard copy book, there is business valuation. We are going to use it. So the hard copy book is equally important to this book. So we are going to use all the two documents for the class. But note that if you need any other document, you are going to, if you need any other document, the online link has been shared. Kindly visit it and get all other documents to help you. These ones, you are going to get soft copy of questions and you work in groups. And the Google link is where I'm going to communicate to all of you. So if you need any material, you go to the Google link. If you need any question, you go to the Google link. That is that. And we want to employ the use of AI in the learning. So again, as you are here, if you want to search something concerning the work, so you search, what is subsidiary, for example? What is subsidiary? You are able to search and see that, okay, Copilot is saying a subsidiary is a company that you have more than 50% own. So if it is more than 50%, it's a subsidiary. So as part of this study, we will encourage the use of AI, the use of Google search to search for information to use. So you can't come to class and tell me, sir, I don't understand, where you are not able to search for the information online. So if there are words I'm using, you don't understand, you search the word online to look for the meaning of them. If maybe I have said something concerning consolidation, okay, so you must say consolidation. What does consolidation mean? Consolidation in accounting. You search for it, then you type. Consolidation of accounting refers to the process of combining financial statements of a parent and a company and its subsidiary to a single set of what? Financial statements. So we are encouraging that you shouldn't be monotic and say that I'm using only the textbook. No, you should be able to search for information. Some point in time, you can go to YouTube. So I go to YouTube here. So I'm showing you all these things so that you don't come and complain and say that, sir, please, I don't have access to the information. So you go to YouTube, you type, let's say consolidation of financial statement. You type it like this, and YouTube will bring a video. Then there will be a video here. You click on the video, and it is playing for you. It is playing for you. So it is playing. The Google is playing the video for you. IFRS 10, and someone is talking there. Thank you. So what we are trying to do here is that we don't want anyone to stay in the person cannot pass this course. No, everyone. The materials are there. When you go to the internet, you can search for an information. When you go to YouTube, you can search for an information. So this course, we are going to explore everything to be able to do this course well. So some point in time, I'll give you video to watch for some few minutes, and I'll ask you, what did you learn from the video? Some point in time, I will ask you to look at certain things for you to read something and tell me what you learned. That is what we are going to use for this course. So we can't complain that there is no material. Every material is available. Yes, Godwin, please, you have a question, you can ask.
Yes, sir. Please, good morning and thank you for
Good
the
morning, Godwin.
presentation so far.
Yeah.
Yeah, please, with reference to what my colleague asked earlier on, for some time now, you should see we have a guide, which is the model that we've been using. So what I understood from what he wanted to say was that what we have is advanced accounting 1, and the first unit is on PPE. But with what you are presenting on is advanced financial reporting 1, which is totally different from what we have with us. But from what you have said so far, it means you are going to use the two concurrently, if I'm not mistaken.
Right. So, Godwin, you
Yes, sir.
see the outline I have shown over here. This is the
Yes, sir.
outline we are going to follow.
Okay.
So I told you that it is the outline. That's why this outline, the whole Ghana, everyone is having this.
All
The
right,
whole
sir.
Ghana, we have shared it. But because you people will complain that you need a hard book, the hard book, we have print them in numbers. They are there. We can't say because you have paid school fees, we will not give you the hard book. This document was prepared this year. This year is when we prepared this advanced financial reporting 1, which is aligning you with a regular person. So if you have someone in UCC in level 400, if the person is in level 400 now, the person is doing the same topic as you now. But the book you're having is an old book. The regular people have changed their book. So we don't want code people to be different from the regular people. We are all the same certificate. Weekend class, sandwich, and regular, we are all the same people, the same certificate. On your certificate, they will not write you went to distance. No, they will write Bachelor of Commerce, Accounting. So we don't want a situation whereby your courses will be different. And someone will ask you, in your transcript, you are seeing Advanced Financial Reporting 1. What book did you use? We use Advanced Accounting. And the person asks, but this course are two different ones. So why are you using a book called Advanced Accounting, but the course you did was Advanced Financial Reporting? So you want to align. So from this year, everything will now be Advanced Financial Reporting. So all the past questions that you have over there, please forget about them. We are going to give you new questions online. You are going to get new questions in the Google Drive to guide you. You are going to get quizzes from this topic. You are going to get exams from this outline. Kindly note that.
All right, thank you, sir. I just wanted that the latter part of your statement explained what I wanted to ask. If the quizzes will be set on this particular
This
advanced
particular thing is
financial.
what we are going to do.
All right,
This is what
thank
we
you,
are
sir.
going to do. Right. Thank you all. So if there's no other question, then it is good to start the class. Now, when you have, so my board is a little bit dirty, but no problem. I will I will start by going through my slides so that we can be fast with what we are supposed to do. Yes, Adwa.
So please, so concerning the time, we have class at 11:30 to
What class is that, please?
audit and
Audit is at 9:30 to 11:30, please.
okay.
Yes, or the timetable, I'm aware of all the issues, so don't worry at all. Okay, so what are we going to do today? We want to learn concerning group account. Group account. Group account. I have already established that. If you have a business, right? If company A has acquired company B, and company A has control of company B, it means because the word control, company B becomes a subsidiary. Note that. And company A becomes a parent. Note that. If company A goes to company C and go and get between 20% to 50%, it means company A has what we call significant influence. Significant influence. It makes company C an associate. Now, and then also, if company A and company Z come together to form a new business called company Y, we call that one a joint venture. So if company A is, you see, company A is here, company A is here, company A is here. So company A went to company B and had a control over it. Company A went to company C and had significant influence. Company A and company Z came together and decided to form a new company. And so that company, they have what we call joint control. Joint control. So what does it mean? It stands to reason that so company A will use an accounting standard called IFRS 3 and IFRS 10. When company A goes to company C to go and acquire, he will use a standard called IAS 28. When company A and company Z comes together to open a new company called company Y, they will use a standard called IFRS 11. So now, if they are preparing the financial statement, we can choose, if A is there, A can choose to prepare his account only. B can prepare his account only. C can prepare his account only. Z can prepare his account only. And Y can prepare his account only. When they are preparing the account differently, everyone is preparing his or his account. So A is different from B is different from C is different from Z is different from Y. When they are preparing the account, they use a particular, each of them prepare the account differently, we call it separate financial statement. Separate financial statement. And if everyone is showing his account differently, this separate financial statement is governed by a standard called IAS 27. So IAS 27 is called separate financial statement because A has his account and B has his account, C has his account, and Z has his account, and Y has its account. So when they have the account differently, we call it separate financial statement. So you can have, for instance, I'm coming to show you GCB annual report 2024. So I will just download it and show it to you and show what do we mean by separate financial statement, and then as well to group financial statement. So I want to demonstrate everything to you, and for you to know that everything is possible, because online teaching, we are able to show you everything you are supposed to get. So it is still loading, but kindly note that if A is showing its account, B is showing account in the same document, so it's in the same document, we use a standard called separate financial statement. But when we bring the results of A and B together as one, when we bring the results of A and B together as one, we call it consolidated financial statement. Again, when I add A plus B and present it as AB1, it's called consolidated financial statement. And we use a standard called IFRS 10. IFRS 10. This is a standard. And all the standard, we'll go through them today before we end the class today. So now, if that is the case, then I will show you what do we mean by a consolidated financial statement and what you mean by a separate financial statement. Isaac, you can ask the question as I open the document for you.
Yeah, sir, please, good morning. Good morning to my colleague.
Good
Sir,
morning.
please, on what you are saying, I want to find out if a company, let's say, Angel Group, let's take the radio station alone. You have Angel from at Accra, Angel from Kumasi, Angel Sunyane. Now, if he's preparing an account at the end of the year for Accra, Kumasi, and then Sunyane, is that a separate financial statement, or if it is done separately, is it called separate financial statement? And if it is presented as one, can it be called consolidated financial statement? Thank you very much.
Right, thank you. So now, this NG group you asked the question about, they have radio station, they have other businesses, they have TV and that. The first question we need to ask ourselves, whether those ones, are they divisions of the company or they are individual companies they have registered? If the FM is an individual company, it has registered. So what it means is that he has control over that, that group has control over that business. So when they prepare this financial statement of the FM, he prepares the financial statement of the TV, maybe prepare another statement of maybe because I think they are the people who do the Adonko, right? Are they the same people who do the Adonko, the NG group of companies? Are they the people who do the Adonko?
Yes, sir. Yes, sir. They are the same people.
Thank you. Thank you. So now, if they have the Adonko, they have the FM, they have the TV side. These three, when they prepare the individual financial statement and show it in one document, we will call it separate financial statement. But when they combine all their results together and present it as one, we call it consolidated financial statement or the group account. Isaac, please, do you get it?
Yes, please.
Yes. So when they present it as one, they bring all their results together because the same group of company, they have 100% ownership in the TV. They have 100% ownership in the Adonko bitters, they have 100% ownership. In the radio station, we will say that when they present their results together as one, when they add their results together as one, we call it consolidation or group of company. So you see, this is GCB. GCB Bank, you see, this is where the bank, this is individual. So you can see that when the bank here is indicating a separate financial statement, and this one is the group, it means there are other businesses they have, of which they have combined their business together and show it as a group. So in terms of GCB Bank, this is how their financial statement looks like. So this is their statement of profit or loss. So, and the statement of financial position also is here. This comprehensive income, and their statement of financial position also is here. But when they combine their results with other people, they show the group. They show the group. So they may have other businesses of which they do together as one. But note that here, I'm using the word group and bank as an example. But you see that GCB Bank is saying they are group, at the same time they are separate. So you see that the figures are almost are similar, they are the same. But I just want to portray and tell you that there are times that the figures at the separate side is different from the figures at the group side. So this side could be different from this side because they are adding other business to it. But if they had shown maybe another business that they have 100% ownership or investment in it, they would have said, okay, this is A, this is B, and the group is A and B together. That is what it means. So when they bring their results together as one, they are consolidating. They are consolidating. So when you see group, anytime you see group in a financial statement, it is called consolidated finance. So this one is a consolidated. They have added together. They have added together. So this is just an example. You can search for other ones and then you will see what I'm trying to illustrate. So let's go back. So when they are showing their separate financial statements, I'm saying they are using IAS 27. When they combine their results and present it as one, they use IFRS 10. So if you're a company here, if you are a group or you are individual, you are required to use the company's act, of which you learned it in level 300 first semester at 992 2019. You are required to use it. And when you are preparing a financial statement, you need to prepare statement of financial position, statement of comprehensive income, statement of changes in equity, cash flow, and the notes to the account. Now, what are the principles we need to learn over here? So I've taught you what you mean by separate financial statement, and then I've given you what it means. So at least you know what is separate financial statement, you know what is consolidated financial, that is bringing their results together as one. Bringing their results together as one. So now we have, let's pay attention to the standard called IFRS 3. IFRS 3, the name of the standard is called business combination. Business combination. Now, business combination is coming in because a particular business has acquired another business or more business. So business combination occurs where a business or an event where an acquirer has obtained control over one or more businesses. So when an acquirer has obtained control over more than one business, we call it business combination. So if an acquirer, if company A has control over B, has control over D, has control over C, because of the word control, note that if they have control over A, sorry, control over B, control over D, control over C, it is called a business combination. Some people call it a measure. Some people call it measure. Okay, so now when they have control over B, D, and C, we need to know the date they had the control over. So they call it acquisition date. Acquisition date. Acquisition date refers to the date they had control over B, control over D, control over C. So if A went to acquire B on 1st January 2019, you write 1st January 1st January 2019. It is there like that. 1st January 2019. If A went to acquire D on 1st January 2018, you indicate 1st January 2018. If A went to acquire C and the date was on 1st January 2020, so you indicate 1st January 2020. Please, 1 minute. Okay, so sorry, please, let's continue. So what happened here is that with the date indicating over there, it is showing the acquisition date, the acquisition date, the acquisition date. So with this acquisition date, it is telling you the day we had control over them. The day we had control over them. That is what you mean. So the one who is having control over B, the A is having control over B. So A, we will call him acquirer. Because A has control over B, we call A acquirer. And because B are the people who are being controlled by A, D is controlled by B. Sorry, D is controlled by A. C is controlled by A. We will call it acquiree. So all B, D, and C, they are called acquiree. So B is called an acquiree. And then D also is called an acquiree. And then C is also called an acquiree. So always we need to identify, does A has control over B? Does A have control over D? Does A has control over C? Then if you are able to establish that, get to know the date they had control over them. Get to know the date they had control over them. So if you get to know, then it means that the one who has control over B, control over D, control over C, we will call them, A will be called acquirer. And those people we had control over will be called acquiree. So always, you need to establish that indeed one business has control over the other business before you can say that, yes, indeed, these people are acquiree and these people are acquire. And when you are doing that, we need to follow some accounting principle. So we have what we call accounting for business combination. We have what we call accounting for business combination. Accounting for business combination. So with accounting for business combination, we need to note that we need to know the businesses we have acquired. Because when accounting for business combination, we use a particular method called acquisition accounting, and it is very, very simple. I will just illustrate for you to see. Acquisition accounting method. Some people call it purchase method. It means the same thing. So if you want to account for A going to B, A going to C, oh, doctor. Okay. He's teaching online, right? Okay. Okay. Okay, please. Okay. Okay, so A has acquired B, A has acquired C. The process, they will go through it. They go through a particular accounting method. That accounting method they are going through, we will call it acquisition account. Acquisition account. Acquisition account. So that acquisition accounting is what we will use over here. Then, if we are doing that, we need to understand what percentage have we acquired. Is it more above 50? If it is above 50, we will account for this under this method. If it is below 50, we are not coming here. If you are going to purchase, the first question we ask ourselves is, How much are we paying to acquire it? The amount we are paying to acquire it is called purchase consideration. The amount we are paying to acquire it is called purchase consideration. We can pay cash to acquire it. We can use share, so we call it share exchange to acquire it. We can use a loan note to acquire it. We can also use what you call contingent consideration to acquire it. We can also use deferred consideration. I will explain all of them for you to understand. So we can use cash for it. We can use share exchange. We can use loan note. We can use contingent consideration. We can use deferred consideration. So if you are going to purchase company A is going to purchase company B, the amount of money they are paying, either by cash, either by using share, either by using loan notes, either by using contingent consideration, either by using deferred consideration, they all fall under what we call purchase consideration. So then if A is going to purchase B, you go with one of these, or maybe 3 or 4 of these, or maybe all of these to go and purchase B or C. But when he's going to purchase B, we need to know the value of B he's going to purchase. We need to know the value of C he's going to purchase. So the value of B or C they are going to purchase, we call it net assets. So if I want to come and purchase your business, I need to know your value. And your value I'm going to acquire is your net asset. And your net asset, we all know, is asset minus your liabilities. Asset minus your liabilities. That is what I'm going to purchase. So let's say I'm going to purchase company. I'm going to purchase company. A company in let's say Unilever Ghana. So Nestle Ghana decided that Unilever Ghana is not doing well, so they want to purchase the Unilever. The amount of money or the amount they are going to use to purchase Unilever Ghana is called purchase consideration. But when we go there, we should know the value of Unilever. So the value of Unilever is called asset minus liability. Isaac, please, your hand is up. Do you want to ask a question?
No, please.
Right, thank you. So we need to know the value of B and C before A going to acquire it. If we don't know the value, then we can't acquire it. So it is very, very good. We should be able to identify the asset, the net asset of subsidiaries. We should be able to identify the net asset of subsidiaries. If we are not able to identify the net asset of subsidiaries, then it will be very, very difficult, because you may not know what you are going to do. And note that the net assets you are going to identify, they should be at fair value. They should be at fair value. They should be at their fair value. So if Unilever Ghana is there and Nestle Ghana is going to acquire Unilever Ghana, what happens is that we are going to purchase Unilever Ghana based on the fair value of the identifiable net asset. Note that. So note that when we go there and the person has a good role, we are not interested in that. We are just interested in the total asset, all the total asset the person has. And we less all the liabilities, and then we do that. So when you are able to know all the assets of the person, you get to know all the liabilities of the person, then you are good to go. So the amount the person is paying is called purchase consideration. The one the acquirer is paying is called purchase consideration. It's like something he's giving in return for that company. And he said he can pay with cash, he can pay with loan notes, he can pay with a share, he can pay with a contingent consideration, he can pay with a deferred consideration to acquire that. So note that. Now, when he is going to purchase, we said we need to know the net identifiable asset, the net asset. And it should be at what? Fair value. So when we subtract the net assets from the purchase consideration, you get what we call goodwill. We have what we call goodwill. That is what we must note. So the amount we are paying is purchase consideration, and we have the net asset acquired. Now, when A acquires B, he can acquire 100%, everything of B. When A acquires C, he can acquire only 80% of it. So when A acquires B, when he acquires 100%, it means no one owes a portion of B. But when A are going to acquire C, he only acquired what? Just 80%. So it means the remaining 20%, is for people, we will call it non-controlling interest. Non-controlling interest. So when we hear the word non-controlling interest, they refer to the minority interest group. So if the A has 80% and then other people also have 20%, those people, they are the minority people. We call them non-controlling interest. So what would be? They are the people, they do not have control over C. But A has control over C. So because A has control over C, A is acquirer. So we can say that A is what? A parent. And C is a subsidiary. Again, A has 100% control over B. So B is also called a subsidiary. And then A is also called a parent. So who is a parent? A parent is an organization or a business entity that has control over subsidiaries or have control over other entities called subsidiary. So A has control over B because A has 100%. In that case, A becomes a parent. And then B also is controlled by A, so B is a subsidiary. So we can boldly say that B is a subsidiary because it is being controlled by a parent. When we say a subsidiary is an organization that is being controlled by a parent. It is being controlled by a parent. Now, I also said that C also is a subsidiary, but A has what? 80%, and B and non-controlling interest is what? 20%. That is what you must note. So if A has control over C, A too is a parent, but it only has 80%. There are other people who have 20%. So this 20%, they are also called minority interest or non-controlling interest. Note that if you want to determine the value of those people who have 20%, you also determine it based on the fair value. So if you want to determine the value of the people who have 20%, so those people have is at their fair value. So let's say, for instance, C value is 100,000. C value is 100,000. So the parent is who? The parent is A. So A, who happens to be the parent, will have what? 80% of the 100,000, which is 80,000. And then the minority holders who happen to be here, minority holders, so the non-controlling interest like this, who happen to have 20%, will be 20% times 100,000, which is 20. This is 20. So what happened is that the people who do not have control, we will call them what? Non-controlling interest. And those who we have control, will call that. So I said that when the amount of money you are paying is minus the net asset you are paying, you are having, the B's value or C's value, you get goodwill. So let me reiterate it again for you to see. So if you are paying, you have a purchase consideration, and you less net identifiable asset of subsidiary, and you have now established who a subsidiary is. Net identifiable asset of subsidiary. It means that you have a purchase consideration here. You less net identifiable asset of subsidiary. We get what we call goodwill. But someone will ask, so say, what about if the amount you are paying is lesser than what the business is having? So for instance, maybe you are paying for 20, but the value is 50. The value of the subsidiary is 50. It means you are going to get a negative. Yes, you are going to get a negative of 30. That negative is called purchase bargain or negative goodwill. I'm saying that negative is called purchase bargain. Purchase bargain, or we call it negative goodwill or negative goodwill. Negative goodwill. So this is what we have. So when the amount you are going to give is greater, so when the amount you are going to give is greater, so let's say, let me use example here. You are going to give 100,000, but the figure is 50,000. When you subtract, you are going to get 50. When it is positive goodwill or goodwill. But when the amount you are going to give is lesser than what you are supposed you are giving in exchange, you have negative goodwill. That is what you must know. But note that always the difference between, you see that they all have the word goodwill. One is positive, one is negative. So what it means, the difference between the purchase consideration and the net identifiable asset is what? Goodwill. That is what I established at here. That the difference between the purchase consideration and the net identifiable asset is goodwill. But at some point in time, you can get a positive and a negative. When it is negative, it is called purchase bargain. When it is positive, it is called positive goodwill or normal goodwill. Now, when you were doing you're in level 200, you did what we call impairment. When you were in level 200, you did what we call impairment. And impairment is something that it is very, very important over here. Impairment. And we said impairment falls under which standard? Who can tell me? Yes, impairment falls under which standard?
IAS 36.
Thank you. IS 36. Thank you. So, goodwill, when you get the goodwill to, we test for impairment. Not negative one, but a positive one, we test for impairment. The negative one, you don't test for impairment, but the positive one is what we test for impairment. So always the impairment is shown in the book. So when you arrive at the goodwill, this goodwill, when you had the purchase consideration minus the net identifiable assets, you had the goodwill. You had the goodwill like this. Then we less the impairment. We test whether the value of the goodwill has reduced or it has increased. When we test for impairment, we subtract the impairment. Then we arrive at here. We test for the impairment. So when you test for impairment, the impairment will go to profit or loss. And then you have what we call goodwill at reporting date. Reporting date. So this goodwill as reporting date is what you send to the statement of financial position. All these things, they are in the slide. Sorry, they are in the document. When you pick, you can see them. But I'm trying to illustrate it so that when you pick and you are reading, you begin to appreciate that, okay, the teacher was trying to talk about this. So let me try and relate it to the document over there. So now, you've heard me saying goodwill, goodwill, goodwill. You've heard me saying goodwill, goodwill, goodwill. So goodwill, we have two ways of determining goodwill. Ways, approaches to goodwill. Goodwill determination. Approaches to goodwill determination. I told you that if you want to know goodwill, it is just the purchase consideration minus net identifiable asset. That's what I told you. But we have two main ways to do it. We have the partial approach or partial method, and we also have the full or fair value method. That is it. So with the partial method, we have a way of doing it, and we also have the full method. So let us go through the process and then see how it looks like, because they are part of the reading. So if you say the partial method, it is first knowing how much you paid, that is the purchase consideration. And I've told you what goes into the purchase consideration. Later on, we will build on the things I said. I said we can use cash, we can use share exchange, we can use deferred consideration, we can use contingent consideration, we can use loan notes. I gave you 5. Don't leave them. They are very, very important. So with the purchase consideration, we now less the fair value of the net identifiable asset, because you said that the fair value, it should be at what? Fair value. So fair value of net, sorry. Let me do some cleaning here. So fair value of identifiable assets. So now, if you are doing the partial method, you said this is how we do it. But if you are doing the partial method first, if you are doing the partial method, you just need to know the fair value of the net assets of the subsidiary. So this one is of subsidiary. Note the one you are going to acquire. So here, if you want to determine the actual value, it is the parents percentage of the value of the net identifiable asset. Net identifiable asset, you bring it here. Then when you less you arrive at the goodwill. So note that with this one, you are just going to multiply it. The figure you get over here is the percentage, is the parent's percentage of the net identifiable assets. So for example, maybe company C, the parent has 80%, and then NCI, non-controlling interest, has 20%. So if you want to know the percentage, the figure you're going to put at where the cursor is or where the pen is, you just multiply 80% by the net identifiable assets of C. So let's say C's value is 100,000. So when you are doing it, if you know how much, maybe we are paying a purchase consideration of 120. So note, I'm doing an example for you to see of 120. So the amount you are going to pay 120. So if you have to pay 120, and if you want to know the value you put over, you're not going to put the 100 here. No, you are going to say 80% times the 100. Then you indicate here as what? 80. So that you subtract the 80 from the 120, then you get 40,000 goodwill. So if you are using the partial method, you just have to multiply the parent percentage by the value or the net identifiable asset of the subsidiary. That is what we do. That is to know the goodwill. This is how we do it. So look at it very carefully. Just 2 minutes, what I have done. And someone should just summarize what I've done, and then based on this, they will continue. Yes, who is summarizing what we have done? Yes, who will summarize what we have done? Just this one, not all everything, but just this one. I believe in peer-to-peer teaching, so anyone over here can summarize. Yes, Patrick, thank you.
Okay, so we wanted to calculate for the goodwill. So in doing that, we need to determine the fair value of the assets, the net assets, identifiable assets. So to do the calculation, if we are buying, we are buying
Yes, since his network, Patrick was talking about your network. Can you reposition yourself? Patrick, you can't hear you. Okay, as you are waiting for Patrick to his network, so Isaac, you can come in. Isaac, please, your hand is up. You can come in.
All right, sir. Sir, please, I want to try. We are looking at the approaches to goodwill, and we are looking at the partial method. And what we are trying to do is that we have, let's say, company A has acquired company C with 80%, and the rest of the 20% is owned by another entity. That 20% refers to the non-controlling interest. And so if you want to find the goodwill of that company, you if you want to find the net identifiable asset at fair value, then what we do is that you calculate, you take the 80%, then you multiply by the total asset, which is the 100,000, to get 80,000. Then you less it to arrive at the goodwill, which is 40,000.
Good, thank you. Okay, thank you. Another person who also want to give another so how the person understands the person can also share with us. Yes, another person wants to help us. Hey, no one is willing to help us again. Doesn't whatever I'm teaching you don't understand. Then I have to call names. Gabriel.
Hello, sir.
Yes, please. Can you tell me what you've heard concerning this aspect of what you are doing?
For what I heard is, we are finding an approach to, like we have two ways to determine the goodwill. Yeah, so we were using one approach where um, you, if you are given the purchase consideration, then you have to find the identifiable asset, the fair value of it, and so that we will be able to deduct it from our purchase consideration or considerable purchase value. Then we will get the goodwill. But sir, I also have a question where you see we were using 100,000,
Yes.
and then we had to get the parent value or parent percentage 80% from it, and then we had 80,000.
Yes.
Yeah, but in the next one, the purchase consideration was 120,000, and 80% of 100,000. So that point, I'm a bit confused.
Right.
Can you
So
please?
the purchase consideration, we are going to pay 120,000 to acquire a different business. And then the parents, the business we are going to acquire, we are going to have 80% in that business. But then
Okay.
that business we are going to acquire, the business value is 100,000. So the question is that if you are using the partial method, should we use this whole 100,000, or we should
Yeah, I'm
just use
sorry.
a portion of the? Patrick, don't worry. We should just use the portion of the 100,000 that is for the parent only, because if it is a partial method, we are saying that we should use the parent's percentage. That's the reason why I was multiplying the 80% by the 100. But if it were to be the full method, that one is different.
Okay.
So let me show you the full method too, please.
Okay, sir.
Right. So with the full method is that full method is here. So let's watch it carefully. Full method, you know how much the person is paying, purchase consideration. Then as well too, we know we should bring the value, the fair value of non-controlling interest. These are the minority who interest group. We bring it. Before we less the net identifiable asset of subsidiary. This time, it is the full value, full amount, full. So I've written full here. The other one, I wrote parent percentage. Here, I wrote full. So the full amount is what you are going to less. When you less, you arrive at the goodwill. Goodwill. So you see the example I have over here. NCI is 20%. C's value is 100. We are paying 120. Parent is 80%. Let me treat it here and say that parent 80%, NCI 20%. Then C's value is 100,000. Then purchase consideration, we are paying 120. So let us put it there. We are paying 120 on the same line, 120. But if you want to know NCS value, it is just NCS value is 20% of what? The subsidiary value. Because subsidiary value is 100%. So we will have 80%, and then NCI, non-controlling interest, will have what? 20%. So in that instance, you will get 20% times the 100, which will give you 20 for NCI. Then when we come here, you will less the full value of the subsidiary. So when you less, you will get 40. So you see that this 40 is the same as this 40 here. This 40 here, I didn't less the full value of the full value of the subsidiary. I just use a percentage. But here, I use what? The full value.
Sir, please, can you kindly go over again?
I'm saying that for the full method, you are going to pay 120. The subsidiary's value is 100,000. Parent percentage is 80%. NCI is 20%. So for the full value, you bring the purchase consideration. Then you now bring the value of those people who have 20% in C. But C's value is 100. So other people who have 20% is 20% of the 100, which gives us 20,000, which gave us 20. So with this 20, we now add the 20 to it. But when you are lessing the value of the C, we less the full amount. The word is that full. That is the whole 100. Then you get 40. Unlike the partial method, we are lessing only 80%. But with the full method, we are lessing 100%.
Okay, thank you.
Right. So we've now seen the difference between the two methods. The difference between.
Listen.
Yes, sir.
So please, it means that the NCI, we add it to the purchase consideration before we subtract the 100,000 from. That's how come we got the 40,000.
Yes.
Okay. Thank you.
Right. Any other question? Okay. So, few things to end with before we come at 11:30. I made mention of purchase consideration, and I said a lot of things goes into purchase consideration. Can someone repeat what I said? Can someone tell us what goes into the purchase consideration? Yes, sir.
Sir, please, you said with the purchase consideration, the acquirer can either use cash to buy the stake or the percentage controlled in the acquiree. And the acquirer can also use shares to buy it.
Okay.
The
Shares.
acquirer can also use deferred consideration. The acquirer can also use contingent consideration payment method.
Okay.
And the loan.
Okay, thank you all. So let's take the thing one by one, and then um, explain. When we say cash, cash means the person is going to use money to pay for it. When we talk about share exchange is just saying that we company A is going for B or C. Let's say, so we are using C, so let us maintain the C. So company A is going for C. Now, company A has shareholders. Company C has shares we are going to buy. So if company A has shareholders, and company B is going to acquire company
Company A is acquiring company C.
yes, and company A has its own shareholders. And then C has shares. So what will happen? Company A will tell company C that for the shares I want to buy, your company I want to buy, I don't have cash with me, but my shareholders, I want them to get extra shares. So every share I'm coming from you, I'm going to give it to my shareholders at our share price. That is the meaning. Again, company A is telling company C that your business I'm going to acquire, I don't have the money, but rather I want my shareholders to pay for it. I don't want a situation whereby I will pay cash, but rather I want my shareholders to have shares. So every share I'm coming for, my people will give something in exchange based on my share price. So let's say, assuming that company C has maybe 50,000 shares, I can tell my company A people can tell their shareholders that we are going to acquire 50,000 shares of company C. We don't have money, but you people have to pay for it. So what do? For every shares we acquire from here, we will give your shares in exchange for it. So they will say that, so this is what company A will tell the shareholders, say that for every 2 shares, so this is just an example, for every 2 shares acquired in C, we will give 3 shares at 4 cedis. So company A will be telling the shareholders that for the shares they are going to acquire in company who are going to do that, they should, we are going to give them every 2 shares we acquire, we will give 3 in addition. We will give 3 in addition. So what it means is that if we have the 50,000 shares over there, we just need to divide the 50,000 by 2, saying that for every 2 we get in 50,000, we multiply by 2 at the price of 4 cedis. We will take examples for us to see, but I just want to tell you what is happening over here. Okay, so this is what happened. Right. So anytime there's a share exchange, this is what happens. We will pick examples to look at it. That's fine. Another one is contingent consideration. When we say contingent consideration, what it actually means is that something should happen before we can pay. So if you make a particular profit before we will give you this amount of money, that is what contingent consideration means. Deferred consideration. Deferred consideration means I'm not having the money today. I will pay in future. So instead of me to pay you the money today, I'm deferring the money into the future. That is deferred consideration. And the loan note is just trying to say that the amount of money that I'm going to give to you is a loan I have gone for to make the payment. So this one is not cash, it's a loan that I've gone for to make the payment. So these are the 5 ways of purchasing it. Today, we are not into the calculation. Today, we want to understand some of the items in them so that later on, when I reiterate myself and then we start the calculation, you understand. So it's 9. I have to enter into another meeting at 9 with the tutors in Ghana here who are teaching advanced accounting. I need to explain certain things to them at 9. So please, we will end and then we'll continue at 11:30 as we agreed. I'm hoping that everyone will enjoy the class afterwards. Currently, as we stand now, we have done unit 1 to unit 1, section 3. So when I come, we'll do unit 1, section 4, unit 1, section 5, and unit 1, section 6. I'm hoping to see you again. All the lectures will be recorded, so you have access to it. Thank you very much for your time, and we will meet. Thank you all.
You're welcome, sir.
So
Thank you
all the
too, sir.
questions, let's defer it. Let's defer it at 11:30. The same link, so that if you have any question, come and ask them. I beg you. Right. So we can all leave so that the thing can save for us. We can all leave the link so that we can have it saved. Thank you all. Thank you all.
Thank you, sir.
You're welcome.
Akbar.
You're welcome.
Akbar.